Good morning, Jags. This is Fahad. Today is Tuesday, August 4th. All right, let's get down to it. Mimecast, symbol MIME, Mimecast. Now, this company is out with earnings this morning, and the stock is going to open rather flat. I'm looking at pre-market action. The bid and ask is pretty much bracketing where the stock closed yesterday, and there's not much share volume in pre-market. It's going to open rather flat, but I wonder if this thing is going to push higher after market opens. So keep an eye on this thing. It was starting to break out through major VOP congestion level within the last couple days or so on rather elevated share volume. And I'm looking at this earnings report that came out today, and the company reported a rather very strong quarter. Revenues came in at $115 million versus consensus of $113 million. Total revenue growth was 22% year over year. EBITDA was about 10% above the consensus view at 25.7 million versus 23.6 million estimate. The quarter was driven by traction in the upmarket, which was due to the acceleration in semantic replacement opportunity. So the company is taking market share from the customers that previously were using Symantec. And they also saw increasing services per customer, and this is an important point. They saw per customer was using more services in the second quarter than any other time in the previous quarter. And so the number that they put out is 3.4 services per customers versus 3.2 previously. And then the last thing was they added a total of 38,600 new customers in the quarter. Now, some other parts that you need to know about, which is that despite the positives that were clearly evident in this report, the environment is still pretty challenging. And, particularly when it comes to adding more and more new customers, mainly because the smaller customers, which is the small and medium-sized businesses, continue to be very, very careful about what kind of expenses they want to add on the books. There's also some restructuring and headcount reductions that are taking place in some of their larger customers, so which may have caused a little bit of, just a pause on in terms of the total activity. However, despite all those things, the company continues to be quite positive on its outlook in the second half of 2020. And so overall, I would give it an A. I would give it an A grade to this quarter. The stock is starting to technically break out. I think it should be well received by the analyst community. And so let's see if this can punch through $50 per share and potentially make its way towards this gap hill, which is a gap fill up to $52 per share, and then potentially all the way to new 52-week high. So keep an eye on this stock called Mimecast. This is a cybersecurity name that we have covered many times in the past. Another name is a quick update on TDOC. I know a lot of our clients have always high interest in this name because we have traded this multiple times. There was an update that came out. Let me pull my research note over here. Telehealth. I thought I had it up. Here you go. In case if you missed the news, but yesterday the CMS proposed changes to expand telehealth permanently, which is consistent with the president's executive order. More specifically, yesterday, President Trump signed an executive order on telehealth and rural health care. The CMS is now proposing changes to expand telehealth permanently consistent with the executive order. During the public health emergency, CMS added 135 services such as ER visits, initial inpatient and nursing facility visits, and discharge day management services that could be paid when delivered by telehealth. CMS is also proposing to permanently allow some of these services to be done telehealth, including home visits for the evaluation and management of a patient in the case where the law allows telehealth services in the patient's home, and certain type of visits for patients with cognitive impairment. Lastly, CMS is also seeking public input on other services to permanently add to the telehealth list beyond the PHE in order to give clinics and patients time as they get ready to provide in-person care again. CMS is also proposing temporarily extend payment for other telehealth services such as ER visits for a specific time period for this particular calendar year, which will likely be renewed for continuation into 2021, and so on and so on. Now, what in the simplest term, what's happening over here is that the President Trump's executive order, as well as the CMS ruling that they have put out, the guidance is pretty much in sync, which is to make as many parts of visiting a doctor a permanent telehealth proposition. Now, this is naturally very positive for TeleDoc, which has also started to benefit from all of these secular changes. So if you look at the stock in pre-market, it is trading slightly higher, even though the S&P futures are down. It closed at 237. It is pushing towards 240 in pre-market. It's a high quality name, and if you look closely, this $240 level is the actual technical resistance. There was a high volume power candle after earnings came out recently, and so it is attacking that level 240 in pre-market. It's likely going to break out through that, see if it can catch some weekly call options, which always seems to be pretty strong in this particular name, and likely push higher over time. So keep an eye on this one too, TeleDoc. And the last stock I want to cover real quick is CRNC. I think that's how you say the name, CRNC. For those who do not know, CRNC is one of our top picks in the Jaguar third quarter outlook. This stock is also breaking out in pre-market. It closed at 41.48 yesterday. Looking at pre-market, is trading at $43 and change. So it's up about 4% in pre-market. It's going to take out this resistance and is likely going to gun for $45 to $46 per share. So I expect a breakout. The MACD has stabilized and starting to give a bull cross. Similarly, the RSI has come in and is starting to move higher for a potential breakout at this time. So keep an eye on CRNC. Now, the company is reporting earnings this morning, and as we expected, is rather a pretty strong quarter. This was also covered in today's first read in case you missed. So here is today's first read, CRNC, and you will see that very strong beat on the earnings per share line, coming at 31 cents versus 8 cents estimate. Revenues were also very strong, coming at 74.8 million versus 61.4 million estimates. So that's a beat of more than 20% above the consensus. The forward guidance, Q4 guidance, was raised a couple percentage point above the street. If you look at the midpoint of that guidance, and similarly, EBITDA guidance was more than 10% above the consensus. This was the second highest bookings quarter in the company's history, according to the CEO, who talked about in this press release that they had strategic wins in all geographic markets, and they continue to be well positioned for continued gains. And they're targeting major growth until 2024 based on these strategic wins. I really like this company because if you think about, it's a perfect balance between a company that is providing the key technologies for future AI-driven or autonomous driving models that's going to be coming out for next several years, which is going to be powered by voice AI, artificial intelligence, that is. And so that's going to be the precursor for how we drive, how we interact with technology in a car. Lots and lots of high-tech stuff, and Tesla clearly has the lead, but pretty much everybody is moving in that direction. And so this company is going to continue to provide their very key technology, voice AI applications in all sorts of auto models that are coming out for several years to come. Really like this company for long-term. Stock is breaking out in pre-market, so keep an eye on this name. That's it from me. Chronicle?
Morning. So yesterday, the company Liberty Latin America, symbol LILAK, was briefly mentioned in the chat because of an unusual call buyer. I was actually short this company a couple years back, so I thought I'd add some color to that discussion. First off, what this company does is it provides mobile and cable services and basically a telco services, mainly in Chile and Puerto Rico, but also in several other Latin and Central American regions. They're essentially the market leader in a lot of these places, and They were initially spun off from Liberty Global. Symbol for that is LBTYA. And it started off as a tracking stock. But to cut a long story short, the reason why Liberty Latin America had been struggling the last 3 or 4 years was down to three reasons. The first one being a very poor management team that was overpaying for its acquisitions. The worst one being the takeover of a company called CNW in 2016 for roughly 8 billion in US dollar terms at the time. And then it turned out to be a very slow grower, like we're talking low single digit organic growth. If I recall, the math at the time would have been like after 2028 when they made back the money. And separately, if you recall, there was also a series of bad weather and hurricanes back in 2017, which messed with a lot of the infrastructure in Puerto Rico at a time when the company's leverage had roughly tripled within the space of roughly 18 months. So this half of the bear case was just bad luck, while the other half was the overpaying for M&A. Lastly, the company's subsidiaries and acquisitions were also fragmented to the point where it was just difficult for a lot of sell-side analysts to get a clear visibility into their earnings. So as a result, the stock was largely ignored by the larger institutions. That and the parent company, Liberty Global, also had its own share of problems, which I won't go into to save us time. But if we were to fast forward, I have to say a lot has changed. The most important thing is that management has gradually improved. So the former CEO who was responsible for making a lot of the poor decisions, he was replaced in late 2017. And the new replacement, Balan Nair, he put a plan in place to start prioritizing free cash flows and making sure that future acquisitions would be shrewder, while still emphasizing the company's attempts to corner the Central and Latin American market. That was a great story initially, but it didn't turn out to be an immediate turnaround because the company was still hitting a lot of road bumps with regards to subscriber losses in several countries and also the ongoing problems in Puerto Rico, which is why I was short the stock despite the management change. But since then, it looks like management has finally managed to reverse its subscriber losses as well as its free cash flow trends. In fact, they managed to return to positive operating cash flow growth on top of paying less for M&A. Like in the most recent example, in the second quarter this year, they acquired AT&T Puerto Rico for $1.95 billion, so roughly 5.5 times operating cash flows, which isn't bad considering they were paying double-digit multiples for the CNW acquisition if we strip away synergies. So that AT&T acquisition alone should already be a major bull case because it's going to add roughly just over $300 million in annualized cash flow. Before that, the company was guiding to just 150 for this year. So the eventual figure for 2020 is going to more than double the original guidance. And if we were to linearly extrapolate that AT&T segment's growth, because growth in the cable business is pretty linear, that's going to get me to about 350 million in cash flow by 2021, which implies about 15% growth next year, which is pretty decent for a telco. And that's before factoring in the Telefonica acquisition that was mentioned in yesterday's live chat, because we're yet to get a lot of color on that. Finally, another thing is that the subscriber losses in some of the company's difficult regions have started to flatline and turn higher over the last year or so. Plus, Puerto Rico has been gradually getting over its hurricane damages. Although, if we look at the news, they are having some problems currently with Hurricane Isaias this week and next. But to sum everything up, it looks like this company is turning the corner. I used to be a bear, but not anymore. Is it going to be a multi-bagger? Probably not. I wouldn't go that far, but if we look at the chart that I shared in our internal chat, based on 2021 growth numbers, I think the stock can get to the resistance level at $14, even though it's been consolidating. The RSI has been showing a clear bullish divergence, just needs a catalyst. The company is reporting tomorrow.
Sorry about that, guys. There was a long pause here. I put my microphone on pause while you were talking. Anyways, what I was saying was that the cash flow story that Chronicle let you explain is actually quite strong. Isn't that the real main case over here? Because if you're talking about potential free cash flow doubling by adding more than $300 million this year with the restructuring and everything else that we talked about, and then the Telefonica acquisition, the assets of Telefonica will add more into 2021 projections. This becomes a deep value stocks for anybody that will screen, this name for Latin America, potentially making the case that there could be substantial upside from here. And just to point out to any audience that's specifically interested that yesterday they were buying these January 15 call options. Over 3,000 of these were added to the open interest overnight versus a stock at 10. So 15 is all the way here. So am I hearing this correct? Main story over here is really just a deep, deep value in Latin America with the free cash flow story.
Yep, that's really it.
Yeah, interesting idea over there. Jay.
Hey, Fahad. So I just want to talk a little bit more about FIVN, FIVN. Company reported earnings after the bell yesterday. The numbers are shown in today's first read. Beat on the top and bottom line. Billings were a beat. Full year EPS and revenue guidance also a beat. Now, JP Morgan kind of started their post earnings note off by saying, 1 quarter ago, the market was pleased with the results, but wondered how sustainable the level of demand would be. Well, these numbers kind of showed the tremendous amount of durability the company has right now. And I want to kind of break this down into partnerships and products. So from the partnership side, management highlighted that they experienced booking strength on all fronts, both commercial and enterprise, and for both new logos and their installed base. They were happy to report that not only were bookings from global SIs more in Q2 than all of 2019 combined, but they also represented an all-time record as they continue to strengthen their partnerships with Deloitte, Ernst & Young, Accenture. They also announced a strategic partnership with CDW. And then they also announced a logistics company and a retail services company signed respective 4.8 million and 5.9 million annual subscription revenue deals, which JP Morgan called some of the largest initial deals in history. And then the management also talked about the progress that they've made with their AT&T partnership, which looks to be a revenue contributor starting in 2021. Now, from the product side of things, management said that they have a summer release being rolled out right now. This release delivers 139 new features, including over 20 features from Global Voice and a major up-leveling of their support for digital channels. They announced 4 new package workflow automation applications powered by Wendoo, their no-code platform. And they received commitments from 10 customers to implement their Agent Assist product, and about half of them are expected to go live with production traffic this month. So just a solid quarter overall. This was a Q1 top pick, and it has essentially doubled. And we're looking at, I think, maybe a 2 to 3% move pre-market. So just another 52-week high once the market opens.
Yeah, this is a former Jaguar top pick, and it continues to perform so well. Revenue growth 29% year over year, and also sequentially increased by 5% quarter over quarter. EBITDA margin of 18.3% was 18th consecutive quarter of positive operating cash flow with a steady improvement in margins. So the company is definitely getting the benefit of scale as the top line revenue continues to grow. What was the one comment that you mentioned about biggest deal that will benefit? Something I heard briefly there as you were talking.
Yeah, so they had a logistics company and a retail services company signed respective 4.8 and 5 million annual subscription revenue deals, and JP Morgan referenced those as some of the largest initial deals in the company's history.
Yeah, so when I hear comments like this, one of the things that we have to be extremely careful about, and as I go through a lot of these earnings reports on a daily basis of our favorite ideas, is that when we look beyond just the second quarter earnings that are coming out, we look at Q3, Q4, and beyond. We want to make sure that the companies are going to be able to sustain some form of or close proximity to, the similar kind of growth rates. And, because it becomes difficult as comps get difficult, it becomes difficult to see, a leaner extrapolation of the kind of second quarter growth metrics that some of our favorite stocks are reporting, because the growth in some of these areas will potentially slow down the road when comps get difficult. But when I hear comments like that on 5.9, but on top of sequential improvement, it's a vote of confidence that not over here. You can still continue to extrapolate similar kind of growth rate for potentially more quarters to come well into 2021. I understand the chart is a bit overbought over here, even though it's going to power higher, it's going to open a few dollars higher, but the RSI MACD levels are a little bit overbought. I still think it goes higher, but I would favor a little bit of a pullback before stepping in. But what a remarkable quarter, I have to say. Fantastic stuff there. Avo.
Quick one this morning. Carrier is the company, CARR, the ticker. Now, this was a spin-off from United Technologies when they were going to do that equal merger with Raytheon. So that was done early this year, actually. So the company reported a pretty decent quarter, actually, and their North American orders rebounded 40% in June, and this is year-over-year data, 40% in June, and of that, 100% rebound in residential HVAC. Now, this is over depressed numbers from prior data as well. So I'm just looking at the numbers here, and it looks pretty good to me, but although a little bit overbought here, I think as they set up for even more potential business from office buildings, trying to get into healthier air circulation, because as you know, traditionally there's been what we call the sick building syndrome, that they don't have a lot of circulation going on there. So there's that potential. There's the residential factor that is increasing with new buildings, not buildings, but new homes being built. Also, another company, JC Controls, JCI, had a September put seller. I think it was one large seller that went through yesterday. Essentially about the same type of, not the same type of business, but they have some overlapping businesses with Carrier. So that's also kind of another stock that I would keep an eye on. Maybe not right away. I would just kind of give it time to just go sideways and see what happens. But they both look interesting to me. Carrier more than JC Controls, though.
So they're benefiting from people spending money for new, cleaner air circulation in the environment where COVID is spreading, basically in both residential and commercial.
Well, also new home builds, right? Yeah. And also there's there's the potential of increasing healthy building type of business coming. Because I don't think they're just going to go ahead without changing, or at least trying to do some changes in office building HVAC systems.
I think there may be some case to make over here, but I do want to caution on Carrier one time, because in the absolute terms, this, I think relative to expectation, this was actually a good quarter, but we want to see continuous improvement in Q3 and Q4. But in terms of absolute numbers, sales were down by Carrier by more than 20% year over year, and down 19% organically if you remove the impact of a small acquisitions that the company did. And they did highlight that the decline was largely driven by impact of COVID pandemic across all businesses. However, now this speaks to your point, they did see demand improve as the second quarter progressed and the economic activity resumed, particularly in the housing sector. So they also
especially in June.
Yeah, and then they also talked about some of the very key products, including the one called Acceleration in Carrier 600. I'm not exactly sure what that is. I think there's more to be learned from this earnings call. I'm sure there are points to be taken from the management commentary that could give us more color as to how the company is progressing from here. Interesting name. Never actually had this on my watch list, but maybe maybe one to add to my watch list in the future.
Yeah, well, because it was part of Raytheon, right? So not Raytheon, United Technologies. So it was just one of their subdivisions.
Sounds good. All right, guys. Thank you very much for joining. That's it from us. We'll see you in the chat room shortly.